Hello. This tutorial will show you how to compute the present value of future payments with compound interest. This example comes from the HP12c Platinum Financial Calculator User's Guide Edition 5. Suppose you want to ensure that you can finance your daughter's education 14 years from today. You expect that the cost will be about $6,000 a year, which is $500 a month, for 4 years. Assume she will withdraw $500 at the beginning of each month from a savings account. How much would you have to deposit into the account when she enters college if the account pays 6% annual interest compounded monthly? So in other words, when she enters college, how much money do you have to have in that account so that she can withdraw $500 per month for 4 years? Remembering that while she's withdrawing, the remaining balance is still earning interest, so you need to account for that. I've tried to bold and underline the key components of this problem, which you'll need to use as you use your HP12c. Those key figures are N, which is the number of periods. In this case, she will be withdrawing that $500 for 4 years, 12 times per year because she's doing it monthly. So effectively she will make 48 $500 withdrawals. Next, it said that the compounding rate was 6% per year. So if you divided that by 12 periods per year, that's effectively 0.5% per year. So half a percent per period. So if you take 0.5% per period, which is a month, multiply it by 12 periods, you effectively come up to 6% per year. PV is the quantity to be calculated. In other words, what will the present value at the beginning of this 4-year period need to be? How much money do you have to have in the account at the beginning of that 4-year period? So we're trying to compute that present value, looking ahead 4 years. So the fact that this is going to be 14 years from now, that would be another problem. In other words, how much would you have to put into the bank per month between now and 14 years from now so that this amount would be there for your daughter? We're not worrying about that. All we're worrying about is how much needs to be in the account at the beginning of her 4-year college period. The payment out to your daughter each period or each month would be $500. The future value, meaning at the end of the 4-year period, when your daughter hopefully graduates, should be 0. She will have drawn down the full account, and hopefully she will not need any more money at that stage. Now we're ready to use the HP emulator. This should be what you have in your hands, your actual HP12c Platinum. The first thing you want to do, just in case there is any old data in here, is you want to clear the previous data. So you click the F button, then clear, and then your F button again, and then you can choose your display digits. If you want to have 2 decimal places, that would put 2 here. If you wanted more than that, you'd go F, clear, F, and let's say you wanted 4 digits. That's how you do that. So anyway, let's put it back to F2, and that just simply clears the data. Next, let's input the number of compounding periods. As we mentioned, there are 4 years, but she's doing that 12 times per year. Now we can start inputting the key data. As we mentioned before, we have 48 compounding periods. One way to get that information into the N here would be to type 4, then G, which is going to put in this alternate function mode, which is 12x, and still under N here, and you hit that button. So that puts 48 into the N here. Next, we're going to calculate and store the periodic interest rate, which would be 6. We're going to put in the alternate function mode here, G, and 12 division, so it divided that 6%, that 6 by 5, and it's an interest rate, so it computed it down to 0.5 there. And then we have our payment, which is $500, and we put that into PMT. And then we're going to go G, begin. What that means is that the payments are going out at the beginning of the period as opposed to at the end of the period. And then we hit the PV button. So what that means is at the beginning of this 4-year period, however they got the money, whether they saved it over 14 years or somehow sold something off and came up with the money, it doesn't matter, they need to put $21,396.61 into this account, which is earning 6% compounded, and that should be sufficient to get her through her college education.